If you had 5 employees a couple years ago and you have 20 today, but your insurance program looks basically the same, that should be a red flag because you're not insuring the same business anymore. You've got more employees and probably more revenue, definitely more revenue, more assets, and a whole lot more opportunities for something expensive to go wrong. And some of the coverages you barely had to think about when you had 5 employees can become really important when you have 20. The problem is, most business owners don't think about insurance every time something changes in their business. You're focused on hiring the next person, taking care of customers, buying equipment, bringing in more revenue, all the things you're supposed to be focused on. Meanwhile, your insurance can quietly fall behind. And you don't want to find that out when there's already a claim. So in this video, I'll show you which insurance gaps tend to show up as your team gets bigger, why some risks become dramatically more important once you hit 15 to 20 employees, and how to make sure your insurance keeps up with your business so that you're not finding out about a missing coverage after there's already been a claim. But before we get into the specific coverages, think about buying your kid a really good pair of shoes. You get the right size and they fit perfectly. They're comfortable. There's absolutely nothing wrong with them. Then 6 months later, your kid puts them on and their toes are jammed up against the front. Did the shoes suddenly become bad shoes? No, your kid grew. This is happening to me all the time right now. And I think that's a really good way to think about your insurance when your business is growing quickly. The insurance program you had at 5 employees might have been perfectly appropriate for the business you had at the time, but now you've got 20. More people are making decisions. More people may be driving. People may have access to your systems and your data and your money. You're hiring more people, firing more people, and probably generating a whole lot more revenue. The business grew. So, just like those shoes, at some point, you need to stop and ask, does my insurance still fit? And one of the first places I'd look is your vehicles. Now, when you only have a few employees, the auto exposure in the business can be pretty simple. Maybe you're the owner and you're driving your own car around. You go meet a customer, run to the bank, pick something up for the business, whatever it is. But as you grow, that starts to change. Now you've got employees visiting customers. Somebody's running out to pick up supplies. Somebody else is driving to a job site. Maybe you've got employees renting cars while they travel. And eventually, you may start buying vehicles specifically for the business. One of the biggest mistakes I see at this stage is a business buying vehicles but putting them in the owner's personal name. If that vehicle is really a business asset and is being used in the course of the business, you need to make sure the ownership and the insurance are structured properly because you created a corporation for a reason. Part of the idea is to create separation between you personally and the business. You don't want to casually blur that line by owning business assets personally and then using them in the business. But there's another auto exposure that's really easy to miss. Let's say you don't own a single company vehicle. Does that mean you don't have an auto exposure? Not necessarily. If one of your employees gets in their own car and drives to a client meeting, runs to the bank, picks up supplies, or does something else on behalf of the company, they're using a vehicle the business doesn't own for business purposes. And if they cause a serious accident, the business could potentially get pulled into that claim. That's where hired and non owned auto coverage becomes important. Non owned auto generally deals with vehicles the business doesn't own, like an employee using their personal car for company business. Hired auto generally deals with vehicles the business rents or hires. And this is exactly the kind of exposure that can sneak up on you as you grow. At 5 employees, maybe you know exactly who's driving and when. At 20, you may have people doing things on behalf of the company every day that you don't personally see. So when your business starts growing, don't just ask, do we own any vehicles? Ask two questions. Who owns the vehicles and who is driving what on behalf of the business? Because your auto insurance needs to match what is actually happening in the company. And as your business gets bigger, it's not just the number of things that can go wrong that changes, the amount you could potentially lose changes too. Because if you've grown from 5 employees to 20, odds are your headcount isn't the only thing that's grown. Your revenue has probably gone up. You're doing more work. You may have more customers, more contracts, more vehicles, and just more activity happening every single day, which means you have more opportunities for a really big liability claim. And this is where I'd start looking at an umbrella policy. An umbrella basically gives you additional liability limits above certain underlying policies. So let's say you have a serious auto accident involving one of your company vehicles. Your commercial auto policy has a liability limit. But what if the claim goes beyond that limit? That's where an umbrella policy can come in and provide another layer of protection. And this is becoming increasingly important because liability claims are getting more expensive. According to Swiss Re, U.S. liability claims have increased 57% over the past decade. And in 2023 alone, they identified 27 court cases with awards over $100 million. Now, I'm not telling you that your 20-person company needs $100 million of insurance. The point is that the severity of these claims has gone up dramatically. So if you bought your liability limits years ago when you were a much smaller company, it's worth asking whether those same limits still make sense for the business you're running today. But there's another piece of this that people miss. Having an umbrella policy doesn't automatically mean it's sitting over every exposure in your business. Remember what we just talked about with auto? Maybe you own company vehicles and maybe employees are using their own cars for business. Maybe you're renting vehicles. You want to make sure the appropriate underlying policies are actually scheduled beneath the umbrella so that additional limits work the way you expect it to. So there are really two questions to ask here. First, do I have enough liability limit for the size of the business I have today? And second, is my umbrella actually sitting over the right underlying coverages? Because having a $5 million umbrella sounds great, but what really matters is whether that $5 million is going to be there for the type of claim you actually have. And while growing revenue and operations can increase the size of your liability exposure, there's another really important change happening as you approach 20 employees. You start crossing some pretty significant employment thresholds. And this is one of those areas where going from 5 employees to 20 can change things pretty quickly. When you have 5 employees, you probably know everybody pretty well. You may have hired every single one of them yourself. You probably know what's going on day to day. And if somebody has a problem, there's a good chance they're coming directly to you. But at 20 employees, things start getting more complicated. Now you may have managers supervising other employees. You're hiring more often. You're disciplining people. You're firing people. Employees are requesting leave or accommodations. Somebody complains about their managers. Somebody thinks they were treated differently than somebody else. These are normal things that happen when you employ people, unfortunately. But every one of them can also potentially turn into an employment practices claim. That's why employment practices liability insurance, or EPLI, becomes a much bigger deal as your company grows. It can protect the business against allegations, including things like wrongful termination, discrimination, harassment, and retaliation. And there's something really important about that jump from 5 to 20 that a lot of business owners don't realize. You're actually crossing some significant federal employment law thresholds. Once you get to 15 employees, several federal anti-discrimination laws can apply to your business, including protections involving race, religion, sex, national origin, disability, and genetic information. Then once you get to 20, federal protections involving age discrimination can apply as well. So there's a real difference between employing 5 employees and employing 20. You don't just have 4 times as many employees. You have people making decisions, more opportunities for conflict, and now you may have legal requirements that simply didn't apply to you when the company was smaller. And these claims aren't rare. The EEOC receives more than 88,000 new discrimination charges in fiscal year 2024. But I think the more important thing to understand isn't really the 88,000. It's how ordinary the situations behind these claims can be. You fire somebody. An employee complains about their supervisor. Somebody asks for an accommodation. A manager disciplines somebody. These are things businesses do every day. And you may believe you did absolutely nothing wrong, but that doesn't necessarily stop someone from making an allegation. And now you have to defend the company. So if you're approaching 15 to 20 employees and you've never really thought about employment practices before, this is a good time to have that conversation. Because managing 5 people and managing 20 people are 2 very different things. And your employees aren't just creating more HR exposure as the company grows, you're also giving people access to 2 things criminals would love to get their hands on: your data and your money. Cyber is another coverage that can become a much bigger deal as your company grows. Think about your business when you had 5 employees. Maybe one or two people had access to the bank account. One person paid the bills. A couple people had access to sensitive customer information. But now you've got 20 employees. You've got more email accounts, more computers, more people accessing company systems, more people handling sensitive information, and probably more people who have had some ability to pay invoices, transfer money, or communicate with vendors. Every time you give another person access, you create another opportunity for somebody to make a mistake or for a criminal to fool them. And sometimes all it takes is one email. The FBI shared a case involving an accountant who received what looked like a legitimate request from her CEO and a lawyer regarding an acquisition the company was supposedly making. So she followed the instructions and wired the money, more than $737,000. Except there was no acquisition. The request was fake. And that's something I really want business owners to understand about cyber risk. We tend to hear the word cyber and picture some hacker sitting in a dark room breaking into a computer system. But sometimes nobody has to break into anything. They just have to convince one of your employees to send them the money. And as your company grows, there are more people they can try to convince. This is why I think it's really important to look closely at what your cyber policy actually protects. Because you shouldn't assume that just because you bought something called cyber insurance, every loss involving a computer or an email is automatically covered. Things like computer fraud, funds transfer fraud, social engineering, and employee theft can be treated differently depending on how your insurance program is structured. So, as more people start handling money and accessing sensitive information, you may need to look at your crime and fidelity coverage alongside your cyber policy. And there's an operational piece to this too. If somebody sends an email saying, hey, we changed our bank account, send our payment here, don't verify that request by replying to the same email. Pick up the phone. Call a number you already know is legitimate and confirm the change through a second channel. Because insurance can help protect you when something goes wrong. But the better outcome is not sending $737,000 to a criminal in the first place. And here's the bigger issue with everything we've talked about so far. You can get your auto right. You can get your umbrella right. You can buy employment practices, liability insurance. You can get your cyber coverage exactly where it needs to be. And 6 months from now, you can have gaps all over the place. Because if your business is growing quickly, the target keeps moving. This last one really isn't a coverage at all. It's making sure you have regularly scheduled conversations with your insurance broker. Because if you're growing quickly, your business can look completely different 6 months from now than it does today. Maybe you hire another 5 employees. You buy 2 vehicles. Your payroll jumps. You land a big contract. You start doing a type of work you've never done before. You open another location or start operating in another state. All of those things can affect your insurance. And the problem is your broker may have no idea any of that happened unless you tell them. This is where I go back to those shoes we talked about at the beginning. You wouldn't buy your kid a pair of shoes and just assume they were going to fit until next year because they fit when you bought them. If your kid is growing quickly, you check. Your insurance should work the same way. And this doesn't have to turn into some giant insurance meeting every month. Just establish a regular schedule with your broker where you check in and talk about what's changed. How many employees do you have now? What happened with payroll and revenues? Did you add any vehicles or drivers? Did you move into another state? Did you add another location? Did you start offering a new service? Did you sign a large contract? Did you buy a bunch of equipment? Because sometimes the changes that seem completely normal to you can have a really significant impact on your insurance. Workers' comp is a good example. Your premium is ultimately affected by things like your actual payroll and the work your employees are doing. So if payroll grows much faster than what was originally estimated, you may be setting yourself up for a surprise when the policy gets audited. Or maybe you hire employees in another state. Now you need to make sure your workers' comp program properly accounts for where those employees are working. Those aren't necessarily problems, they're just changes. And that's really the point of all this. When you're growing quickly, you don't need to panic every time you hire someone and start buying insurance policies you don't need. You just need a process for making sure the insurance keeps up with the business. Because the policy that fit when you had 5 employees might have been exactly right. You just don't want to still be wearing those same size when you have 20. And there's another mistake I see businesses make as they grow that can create a pretty nasty surprise on their workers' comp bill. They start bringing on more people as 1099 independent contractors instead of W-2 employees and assume that means those people won't count towards workers' comp. And that's not always how it works. If you get this wrong, you may not find out until the insurance company audits you and hands you a bill you weren't expecting. So click right here to watch 1099 versus W2, the workers' comp cost trap, and I'll show you what you need to know before you start adding 1099 workers to your business.